This is video 3 of SciCat Limited combining debentures in IFRS 9 with IAS 8. We are busy with the journal entries, specifically what should have been done. We are busy with the initial recognition, and we know that initially all financial instruments always have to be recognized at fair value. We don't know the fair value. We know what the debentures were issued for, what the investor paid, but we don't know whether that is fair value. We can't assume it is, so we need to go and calculate the fair value. How do we do that? We use discounted cash flows. We look at all the future cash flows of the debenture. We discount them back using a market-related rate, and that will give us a PV, which represents the fair value. So these calculations will also help you to understand what was done, the amounts for what was done, because remember the question in the little narrative paragraph said that SciCat Limited accounted for the investment at cash amounts the whole time. So when we calculate these cash amounts, it will help you to understand the journals of what was done. So we are looking at future cash flows. So yes, we know that on 1 March 2011, there was a cash flow. The debentures were issued and were purchased by the investor, but we are actually not interested in that first cash flow now. We would like future cash flows. So the first future cash flow that happens is on 28 February 2012. What happens there? 2 things. The interest flows in cash from the issuer to the investor. How do we calculate that interest? Nominal value times nominal rate. The nominal value, please remember, was 1,000 Rand debenture, but there wasn't only one. There were 50 of them. So the nominal value is 50,000 Rand times the nominal rate of 8%. Gives us the first cash flow interest of 4,000 Rand. What else happens on this date? The first maturity payment. The maturity payment is nominal value. A third of that matures now, and it was redeemed or matured at a discount of 5%, so we can multiply by 95% or deduct 5%. So our first maturity payment. So 2 things that happen together on the same day. So when we later on do our cash flow functions on our calculator, whenever there are amounts that happen on the same day, we need to add them together and put them as one cash flow. Because if you put them as 2 separates, the calculator will think the one happened end of this year, the next one only happened at the end of next year. It will take it as 2 different periods. So if there's 2 cash flows that happen on the same day, you need to add them together when you enter it on your cash flow functions. Why am I using cash flow functions? Because this debenture matures not once off, but in 3 installments. In other words, you cannot use the FV, the future value function, on your calculator, because it's not just one payment at one specific date. And because it matures in installments, your interest amount will be different for every year. So you can also not use the PMT, the payment function of your calculator. So that was the cash flow at the end of the first year. What happened at the end of the second year? Again, interest. Nominal value times nominal rate. The nominal rate is still 8%. But look at the nominal value. Why do we not use the nominal value of 50,000? Why do we reduce that 50,000 by 16,667? It is because part of the nominal value, a third of the nominal value, has already been redeemed. The issuer will not pay you interest. The investor will not earn interest on part of the nominal value that was already repaid. So you could also do this calculation, nominal value of 8% times the nominal rate, times the nominal value remaining, which is 50,000 times 2/3, because 1/3 of the nominal value has already been repaid. So your interest amount is different every year because you only earn interest on the nominal value still outstanding, not repaid yet. Your redemption payment will stay the same as in the previous year because this debenture redeems in 3 equal annual installments. For the cash flow, you enter into your calculator. Again, remember, there are 2 cash flows that happen on the same day. So when you enter them on your calculator, because they happen in the same period, you need to add them together. If we then have a look at the last year, the 2014 year, what are the things that happen? Well, first of all, interest. The investor earned interest. Nominal value times nominal rate. Just remember, it is the nominal value still outstanding. The nominal value that has not been redeemed yet. That is the part that earns interest. And then there's also the final redemption payment. That amount will stay the same because the investment matures in 3 equal annual installments. Again, 2 cash flows that happen on the same day. If you enter it into your calculator, you need to add them together. So if we look at the calculator, it's very important that cash flow naught is entered as 0. The first cash flow you enter, it will see as cash flow naught, day 1, immediately, which is PV. If you are looking for PV like we are, you need to enter a naught. Otherwise, everything will be wrong because your calculator will say, why are you asking for PV? You entered something. By putting the naught in, it tells the calculator, that's what I'm looking for. Then cash flow 1 at the end of the first year. Cash flow 2 at the end of the second year. Cash flow 3 at the end of the third year. Your interest is a market-related interest rate, and you look for NPV, net present value, which is the same as PV. It's just the terminology we use when we have the cash flow function, and that represents our fair value on day 1. Because in this question, there were no transaction costs. There were none. We do not need to go and calculate the IRR, internal rate of return. We don't change the PV on day 1 because there is no transaction cost. Therefore, the market-related interest rate does not need to change. We do not need to go and calculate a new effective interest rate. So we do not have another calculator calculation.